Alright everyone, Cowboy Trades here, welcome back to the channel for another update. So are the markets in a 2008 type scenario? That's the question that I want to answer in today's video. To answer this question, what we're going to be doing is taking a deep dive into a bunch of economic data fractals, discussing exactly what was happening in previous recessions in the years 2000 and 2008, and we're going to be comparing this data to what is happening now in 2023, and thus answering, are we in a 2008 type scenario, and should we be expecting a recession to come in 2024? 90% of the charts we're going to be looking at today are all new, so whether you're new to the channel or whether you're a veteran, you're going to find a new chart and you're going to learn something new in today's video. So let's start off with the first topic. All timestamped down below. The first topic is going to be an economic overview of what is happening right now on a fundamental basis. Now, veterans of the channel may have remembered this chart previously when we were talking about are we in 2008. We were approaching it more from a technical perspective due to this 2008 fractal. If we go back to what was happening in 2008, we took a screenshot of the candles, we overlaid it over in our chart and what was happening, and as you can see, these were beautifully tracking up until November of 2022, where there was a significant divergence from what happened in 2008 and 2023 from a charting perspective. So in terms of from a technical basis, you can definitely see the S&P 500 is in quite a lot more euphoria than it was back in 2008. And this can also be seen in the VIX. If we're looking at where we were moving into following 2008, or at least coming into 2008, you can see the VIX was definitely a lot higher, around about 26. Whereas right now the VIX is all the way down at 14 and the markets don't seem to be in too much fear. This could obviously be seen in the chart of the S&P 500. However, in terms of the fundamental groundwork of what is happening right now in 2023, a lot of it is arguably much worse than what was happening in 2008. For example, if we start off on the US interest rates or the Fed funds, you can see right now Fed funds are at 5.5%, and within the next few hours or so, we should have another decision on the interest rates. Are they going to be raising them, pausing them, or cutting them? You can also see down below from an inflation perspective, we recently reached 9.2% year over year on the CPI index, whereas in 2008, we only reached 5.7%. So in terms of where the interest rates are right now, in terms of where inflation is right now, things are definitely looking worse than they were in 2008. Now, one interesting thing I've noticed is that the interest rates tend to top out when the worst of inflation has gone. You can of course see whenever inflation starts to exceed the Fed's 2% year over year mandate, then they look to raise the interest rates to cool the economy. And as you can see, when the CPI tends to come round to this peak level, that is when the Fed starts to think that enough has been done and they start to cut the rate. Over here, you can see CPI exceeded 2%, backtested 2%, and when the worst of it was getting done round about this region, the Fed started to cut here. Now, after the cut, it did go up a tiny bit more. Nonetheless, you can still kind of see the general relationship that the two have with each other. Over here, this is where things get interesting. You can see arguably the worst of year over year CPI has already gone, as we have hit 9.2% and we've seen a drop all the way down to 3.09%. So why have we not seen a cut in the interest rates? And more importantly, why have we not seen a recession hit? Well, first of all, why have we not seen a cut in the interest rates? Well, in my opinion, it's because we see cuts in the interest rates after the worst of inflation has gone. And here's one dissimilarity between what we were seeing in 2008 and the year 2000 as to what we're seeing now in 2023. Previously, when we've seen the CPI year over year start to come to the downside from its peak, this was a sign in 2000 and 2008 that the worst of inflation has already passed. However, if we're looking at the CPI index right now, it's obviously moved down from 9.2% down to 3.2%, but if we actually come over to the CPI index, it has been making new all-time highs every single month. And if we come over to the higher time frames, it will make sense why year over year CPI has been coming down despite the fact that the index is still soaring. This is because inflation was on a relatively steady path to the upside, and then all of a sudden, round about 2021, we just started to witness a parabola to the upside, and since then, we've been been measuring CPI year over year from a parabolic uptrend. So while it's still increasing month over month, we're actually seeing year over year start to come back down to the downside. And this is something that we didn't really see back in 2000 when we had a slight correction, and 2008. Whereas in 2008, you can clearly see this very clear peak and trough down here, in which when CPI year over year started to come down to the downside, that was a sign that the worst of inflation had already gone, as referenced over here in the CPI index, when you can also see on a index level CPI was coming down. Whereas right now, this is what we have dissimilar with the years 2000 and 2008. While CPI year over year has been coming down, and that would make you think, why is the Fed not cutting right now? It's because the CPI index is still persisting, making new all-time highs every single month. And subsequently, why have we not seen a cut in the interest rates right now? Well, it's because, in my opinion, we haven't seen the worst of inflation. Does that mean I'm saying CPI year over year will come back up to 9.2%? Not necessarily, but I am still arguing that the CPI index is still going to be on an upward path and creating further inflationary pressures. And of course, when we do see the worst of inflation and we do see the Fed cut the interest rates, which I think is going to happen in Q1 or Q2 of 2024, this Bloomberg chart detailing the Fed funds and recessions that have followed is pretty clear. Once you see a peak in inflation and inflationary pressures, that is typically when the Fed thinks they've done enough and they start to cut. But when they start to cut, when we've seen peak inflation, when we've seen peak interest rates, this often takes time to take its toll on the economy. And often, once you've seen that cut, it is too late. You do see a recession follow after, peak fear, peak inflation, and peak rates have held for a long enough period of time. Now we've got the economic overview out of the way, let's talk about how this affects the economy as a whole, and we're going to start off by talking about how this affects small businesses. Now we'll start off with the obvious. How do you think high rates and high inflation affect small businesses? Well, obviously not too well. For one, if you're in an era of low inflation, then at least you know that consumers have enough money to buy their regular goods and services. And also from a business perspective, if the Fed funds are very low, then you can borrow money for a very cheap basis. If the Fed funds are all the way up at 5.5%, then it becomes very tricky for small businesses to take out loans and expand, whereas when they're down at 0% or 0.5%, etc., it's very easy for small businesses to expand. So this is why when we come over to our first new chart and look at the percent of small businesses thinking now is a good time to expand, this is why it's at record lows. And you can see this correlates to high rates, as we discussed before. When interest rates are extremely high, businesses don't have the money to expand. So this is just one chart which shows how small businesses are thinking about the economy right now, why we're not likely to see much economic growth from them considering rates are too high and inflationary pressures are too high. And in all of these charts we're going to be looking at today, you can see these red vertical overlays on the chart, and all these highlight is when recessions start and when they finish. So you can look at the data and you can say, hey, when small businesses think now is not really a good time to expand because, these percent ratings are all the way down here, you can see how this economic data comes in correlation with recessions. We'll be looking at some more consumer sentiment indexes later, but if we come over to our next chart, once again, looking at small businesses, this is the Small Business Optimism Index, and this has fallen to negative 9.3% in August. What you can see is often this actually gets a little bit of further weakness once the recession hits, so we may just be moving into that territory where businesses are becoming weak, and as that recession hits, the optimism index continues to break further to the downside. Now, wrapping up on the small business segment, if we look at the August percent of small businesses with job openings, this percent ratio is currently at 40, representing a 9% decrease year over year. I also took the liberty of measuring the max drawdown from peak to recession territory, and what's interesting to note is that a negative 9% year over year change in small business job openings is in line with all of the recessions that we've previously seen in 1990, 2001, 2008, and of course the Black Swan event that happened. So once again, very self-explanatory. When interest rates are extremely high and inflation is extremely high, this is very crippling to small businesses. And the reason why we finished on this chart looking at small business job openings, which are currently falling through the floorboards right now, is this is going to take us into our next segue, where we're going to move on from small business job openings to the job market. Now, recently we had new data come in for the unemployment rate, which rose to a new yearly high of 3.8%. The next reading we have on this is October the 6th, which is going to tell us the September data. But here is what's interesting about the unemployment rate. What you can see is the unemployment rate, and the job market specifically, is one of the last moving markets, which when the unemployment rate starts to move up, this is typically a sign that rates have been high for long enough and CPI has been high for long enough that this is now going to start bleeding into the job market. And when people start losing their jobs, like we just looked at before, job openings are falling. The unemployment rate is rising, and when people start to lose their jobs, just like they did in 2000, just like they did in 2008, that is what really marks the start of a recession every single time. We see this as well in our next chart on the US continuing jobless claims index. Once jobless claims start to rise to the upside, once people are out of their jobs and they start claiming money for this, this is also one of the last signs that a recession is coming. Once these start to move up, it does not take long for these recessionary pressures to hit. Onto our next chart, looking at the employee hours. This is a measure of productivity in the economy. Right now, you can see employees' hours are starting to get cut as the economy slows. And as we just discussed earlier, job openings are down, the unemployment rate is going up, people are starting to claim on the jobless claims, and the total hours worked in the economy contributing to its productivity is just decreasing because interest rates are so high, inflation is so high. A lot of these small businesses, and it bleeds into larger corporations and larger businesses. If we look at the bottom of the screen and we see the maximum drawdown index, you can see basically every single time this starts to come into the red, recessions hit within months. And as you can see throughout 2023, for the past 3 months or so, we have been seeing the job market start to come down to the downside, and this could be a signal that coming into Q1 to Q2 of 2024, this is one of the final signals. If the job market continues to slow down and productivity continues to slow down, that a recession may be right on the horizon. So to summarize everything we've just looked at in the job market with one final chart, I want to show you the US job openings by industry total. So basically the total US job openings are currently down from their peak of 26.6%. And if you look at the maximum drawdown index at the bottom of the screen, like I said earlier, the job market is really a good signal. This is one of the last moving markets, which when this starts to weaken, that's typically a sign that, the entire economy as a whole is pretty much screwed. And when the job market becomes screwed as a result of that, that's typically when you see the recession come, because productivity just slows so much that GDP goes negative, and that's when we see a recession. So what I wanted to highlight is if we look down here at the drawdown index, every single time the maximum drawdown has exceeded 20%, we've broken into recession. Over here you can see we were breaking negative, broke negative, broke negative, round about negative 15%. That is when that recession hit. Over here, you can see once we broke into around about negative 10%, that recession hit. We're currently at 26, and every single time it has exceeded 20, we have seen a recession. I think the only reason why we haven't seen a recession yet is because, like I said earlier, we haven't seen the end of these inflationary pressures. The CPI index is still moving to the upside, which is probably why the Fed hasn't started to cut their interest rates yet. So I don't think we've seen max pain in the economy, and this is why when we're coming over to the job market has still been holding up relatively high. And when we're looking at the unemployment rate is only just started to move up to 3.8%. And once again, like I said earlier, typically you can see once this starts to move up, that is the sign that the max pain is about to be felt in the economy. So we talked about an economic overview of what is happening right now with high rates, high inflation, how this is affecting small businesses, how this is affecting the job market. Let's now look at economic performance as a whole. As I'm sure a lot of you know, the US is not a produce economy, it is pretty much a consumer economy. And if we're looking at the US imports for consumer goods, it is currently witnessing its largest drawdown in history as the US witnesses unprecedented amount of weakness. We're currently at negative 19.5% from peak to low, and this is probably one of the reasons why small businesses are struggling. With rates so high, with inflation so high, consumers really don't have enough money to consume, so small businesses are struggling and they're struggling to hire new workers or expand, and this is bleeding into larger scale businesses which are starting to feel the full brunt of high rates and high inflation. So previously we were talking about small businesses, let's now look at wholesalers and large scale companies. Over in this chart here in orange, we've got merchant wholesalers inventories, and in blue, we've got merchant wholesalers sales on these inventories. Now you'll notice a dip for both of these securities starting to happen as we do come into a recessionary territory. But interestingly enough, you can see what normally happens is merchant wholesalers' total sales start to decrease before their inventories start to decrease. So you see the blue line come down before the orange line. Over in 2019, you did see a dramatic decrease in sales before that recession hit. But if we are actually looking at the peak that happened in 2018, this did happen prior to the peak in wholesalers' inventories. So why is this important, and why does a decrease in sales and inventories often correlate to a recession? Well, it's more about perfect planning for these wholesalers. So if we're looking at their sales, if you're looking at sales start to decrease, but the inventories are not starting to decrease, what does this leave you with? Well, basic economic principle. You've got additional supply. So their inventories are still through the roof. You know, these companies, they have to pay to store that inventory. Some of these inventory goods are perishable. And from a pricing standpoint, it's not necessarily always the best thing to have a surplus of inventories. And that's going to bleed into their profits, which takes us, of course, into our next chart, looking at the drawdown in corporate profits. Right now, corporate profits are drawn down 6.5% from their peak, and every single time you can see over in this chart, we have the corporate profits chart in blue, we have the Fed funds rate in green, and down below you can see the drawdown. Every single time we've seen a drawdown in corporate profit paired with a high interest rate environment, which of course we know is paired with high inflation. Every single time we've seen high rates and drawdowns into corporate profit, this leads to a recession. Once again, over here, you see corporate profits drawing down into a high rate environment. Once the rates get cut, recession. Over here, once again, interest rates get cut, drawdown in corporate profits, recession. Right now, we're seeing rates remain at high levels, and we're just starting to see that drop in corporate profits. And often you can see that drop in corporate profits tends to happen round about peak rates. And to summarize our economics performance segment, if we're looking at retail sales growth year over year, you can see this is currently sitting at a modest 2.5% growth. Now, when sales growth has typically fallen beneath this blue line here, which is at 0.9%, or even worse, if it falls beneath 0%, this has previously been a good indicator of a slowing economy coming into recession. Slowing economy, slowing sales, coming into recession. Slowing economy, slowing sales, coming into recession. And if we continue in this environment of high rates and high inflation, this is going to bleed into small businesses, the job market, and of course, it's going to further worsen economic performance. So with economic performance being so poor, let's now move on to the consumer sentiment segment of today's video, and we'll start off by looking at consumers' expectations for unemployment during the next year. This is basically rising rapidly right now. So the consumer is currently further expecting for unemployment to prevail in the year of 2024. And you can see typically the markets are forward thinking. This is a very well-known economic concept. It's the idea that if the markets start thinking we're going to be moving in a certain way, then we will move in a certain way. For example, if the markets think disinflation is going to happen and prices are going to go down for the next year, then disinflation will happen because they'll be acting in a way which will cause disinflation. If you think that prices are going to become 50% cheaper next year, then you might just be like, well, I'm not going to spend any money. I'm not going to buy any products. I'm not going to buy that new PC or that new TV that I wanted because I can just wait until next year. And then what happens is there's no sales, companies start to lose profitability, companies start to suffer from a loss of revenue, and they have to start pricing things more competitively. And prices do start to come down because that's how consumers have acted in that way. The same way, if the markets think inflation will be happening next year, if you think prices are going to go up by 50%, then you're probably going to act today and go out and buy everything you need, and you're going to act in a certain way thinking inflation is going to come, and if everyone acts in that certain way, then inflation will come. And it's the same thing with things like the unemployment rate. If the markets think we're going to be moving into an area where there's going to be high unemployment, then there probably will be high unemployment. For example, imagine if you work at a small business, let's say you work at a coffee shop, everyone starts thinking that the unemployment rate is going to go to 50% next year. Everyone's thinking, hey, I need to stop spending money. I need to stop going to this coffee shop. I need to stop buying luxury goods. I need to just go to the cheapest store and only buy what I need. Well, what happens to all of these small businesses which rely on customers coming in every single day? Well, these customers are no longer coming in because everyone's expecting the unemployment rate to go up, which means everyone's thinking they're going to be out of a job, which means everyone's saving, no one's spending money. These small businesses start to go bust because of that. They start to let off workers. That starts to bleed into the job market. People start to lose their hours, start claiming for unemployment benefits. And as we looked at earlier, when you see things like job openings and job hours start to come down, this will bleed into corporate profits. This will bleed into economic performance. This is why consumer sentiment is so important. If all consumers start to think that the unemployment rate is going to go up next year, they're going to act in a way which will probably cause the unemployment rate to go up next year. And this is why when you see on this UMich chart of expected change in unemployment rate during the next year, every single time this comes up, pretty much without fail, we do tend to witness a recession as a result of this. Now, if we come over to the University of Michigan UMich Consumer Sentiment Index, consumer sentiment is also pretty much down at new lows. Quite recently in 2022, this made new lows. It has bounced a little bit back up since then, since the stock market did have a rather large rebound. But right now, consumer sentiment is once again coming down to the downside, and we are really in a position where we have been in previous recessions. Another very similar chart to the UMich consumer sentiment chart can be found over here on the CB Conference Board of Consumer Confidence. It's basically potato between these. They're measured in slightly different ways, but they kind of tell you the same thing. It's all about consumer confidence. When consumer confidence starts to come down, when consumers start to lose their confidence in the economy, they act in a way which hinders economic performance. And every single time you see consumer confidence start to break down to these levels, once again, it's typically a harbinger of recession. Now we're coming to the end of the video, and in this segment before the final one, I want to talk about some markets which are doing well. Right now you can see money market funds are actually hitting new all-time highs. Now, if you don't know what money market funds are, they typically invest in short-term risk instruments such as US debt, for example. The money market funds chart is a pretty good way of visualizing when retail traders are overinvested in short-term liquid instruments. Once again, such as debt, for example, if we're looking at something like the 2-year government bonds, this is an example of a debt instrument. So it's no surprise to see that the money market funds are moving in the same way as the 2-year government bonds. The 2-year government bonds are breaking up into new cycle highs since 2018, just like we're seeing in terms of the money market funds. So as we've discussed previously on this channel, when we've looked at things like the yield curve, we've mentioned this many times on the channel. When short-term risk is more prevalent than long-term risk, you see an inversion in the yield curve. And when short-term risk plays are offering you higher yield than long-term risk plays, this is simply a sign that short-term risk is more prevalent than long-term risk. And also you pair this with things like US debt being at new all-time highs, retail being overinvested into short-term risk plays, it's definitely not a good sign. The last time we saw short-term risk being this prevalent was back in the 2020 pandemic. Before then, if we're looking at a proper example of something that wasn't a black swan event that lasted a long period of time, you can see this happened back in 2008. Short-term risk was exceptionally high. That's what caused the inversion on the yield curve. But then when you started to witness the 10-year government bonds catch up and start to exceed the yield given by the 2-year government bonds, this was a sign that we have seen a peak in terms of short-term fear. Even though this is a trough on the yield curve, the bottoms in the yield curve represent when short-term risk is the most prevalent. And once you see that reversion back to the upside, when things like long-term yields start to catch up to short-term yields, and long-term yields once again start to offer more yield than short-term yield because short-term bonds have passed the era where they're in peak fear, once you start to come back to that reversion to the upside, that is when you see recessions start to take place on the yield curve. And the yield curve is currently, just floating above historical new lows. So right now the yield curve is in an interesting position. I do think it's possible that things like the 2-year government bonds can push up a little bit further from where they are right now. I wouldn't be entirely surprised to see it up at 6%, but as you do know, if you have been watching my channel, since the UK bonds hit 5.5% and since the US bonds hit 5%, I took out some short duration bonds as a short-term risk play, as I do believe we're kind of in this situation where short-term risk is probably coming into an era where it's the most prevalent, and because of this, I do think the yield curve is gonna start inverting back up maybe in the next 6 months or something like this. So what I'm personally expecting is at some point soon for these bonds maybe to push up a little bit further. In the macro, I kind of think we're at this peak short-term risk duration play, and as you can see, when short-term risk tops out and the 2-year starts to roll back down, typically after it tops out, it starts to roll back down, and when it's rolling back down, you see a recession take place during the free fall back down to the downside. So I don't think we're ready for a recession this year. Like I've been saying on the channel, I think it comes in either Q1 or Q2 of 2024. Now let's wrap up the video talking about the dissimilarities between 2008, because we've just looked at a lot of instances, a lot of economic data which kind of show we're in a 2008 type scenario. In fact, some of these charts show that we're actually in a more dangerous era and things are much worse than in 2008. But here are the dissimilarities between what is happening now and what is happening in 2008. Now, number one, as we've previously discussed, the markets are a tiny bit more euphoric. If we're looking at the VIX right now is all the way down at 14. We're not really in, peak fear right now, or at least a lot of that forward-thinking volatility has started to price in the fear in the markets. Now, I don't necessarily think that's healthy, and what I will like to highlight is a lot of the time, the VIX can go from 0 to 100 in a matter of a month, 2 months, or 3 months. So just because the VIX is down at these levels doesn't mean that can't change in a month or two. And, for example, you can see over here, the VIX went from 12.6 in November to 54 in March. It can change in 2-3 months or so. Everything can dramatically change in terms of the economic data. But that is one thing that's different between what is happening now and what's happening in 2008. Once again, like we said earlier, in terms of the economic data, things are looking so much worse than in 2008, but the markets are somewhat ignoring this. We're not seeing as much fear as we saw coming into these short-term risk plays. And also you can see we are seeing a divergence in terms of the technicals. In terms of the price charts, what's happening now and what is happening in 2008 is not lining up. In terms of the world fear gauge, looking at the VIX, things are not lining up as much as they used to. One thing that I do want to highlight right now is that global net liquidity is coming down and it is making new bear market lows. It is very, very close, or at least it's kind of on this double bottom stage where it's deciding whether it wants to come down to new lows, but it's basically at these previous lows. And I think what's going to continue to happen is this. In 1 hour's time, probably when you're watching this video, the next FOMC decision will be made. Now, I don't have a crystal ball. I'm pretty 50-50 between whether they raise the rates or pause the rates. It doesn't really matter to me. But what I kind of think is happening right now, these are my thoughts, is that inflation is still exceptionally high. The Fed funds rate is still exceptionally high, and this is very crippling for the consumer, this is very crippling for businesses, and this is very crippling for credit and liquidity. Liquidity is coming down and pretty much at new lows, and while this is happening, if we're looking at things like net percentage of domestic banks tightening standards for credit, these credit conditions are becoming more and more exorbitant. They're increasing to the upside, and you can also see in this chart over here, it has an overlay with these gray vertical bars showing what happens when the net percentage of tightening standards for banks start to increase to the upside. It happened in 2000, it happened in 2008, it happened in 2020. When we see high inflation, this causes high rates. When we see high rates, this cripples small businesses. When this cripples small businesses, it starts to affect the job market. When it starts to affect the job market, it starts to affect economic performance. That changes consumer sentiment. Consumer sentiment changes how consumers start to act in certain situations. And then this just continues to spiral and bleed out, causing higher rates, higher inflation, higher credit standards. And that is typically when you start to move into a recession, with the job market being the final indicator of just that. And with the unemployment rate pushing up to 3.8% recently, with our next reading on the 6th of October, I think the economic data is going to continue to get worse. And whether the Fed raise the interest rates to 5.75, whether they keep them at 5.5, regardless, we're at higher rates right now than we were in 2008. So a lot of the economic data is a lot more worrying and dangerous than it was in 2008. And because of this, my friends, I do believe that we are in a 2008 style scenario, and we're getting set for a market crash much worse than we saw in 2008. So for today, my friends, that is all I've got. I hope you enjoyed this video. Honestly, I know my stock market economic data videos don't do nearly as well as my Bitcoin videos. They also take, no word of a lie, probably 50 times the amount of research as my Bitcoin videos. They take a lot more time, they take a lot more effort, they take a lot more planning. They get a lot less views, but nonetheless, these are the type of videos that I really like to make. If you do like these videos, if you do appreciate the effort, the extra planning that goes into them, then make sure to let me know down below. Help me get these videos trending so other people can see this economic data, other people can see these new format styles of videos in the cryptocurrency markets. Make sure you leave a like, make sure you leave a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button on YouTube and become a member today. It's been your boy Cowboy Trades. I will see you in the next one. I'm out. Peace.